You're watching this special chat with Saion Mukherjee of Nomura today. They've recently come out with a note pegging the Nifty target by March 2020 at closer to 13,000 levels. So I have with me Saion Mukherjee joining us on the show today to take the discussion on markets and macros further. Thank you very much, Saion. You're a rare voice, interact very rarely to media regarding your notes, but the recent one was quite interesting one, closer to 13,000. In such an environment where collapse of growth is really concerning almost every market participant, what makes you constructive on the market at this stage?
So I think, Ajay, the growth concerns have been there for quite some time. And, if you look at some of the segments, especially consumption-oriented segments like autos, for instance, we have been seeing bad numbers and it's getting reflected in the stock prices as well. What makes us somewhat constructive is the fact that on the macro side, if you see the way the cost of capital has come down or the interest rates have fallen, I think clearly from the budget where we saw the government sticking to its fiscal, in fact, it has surprised us positively by delivering a 3.3% fiscal deficit number. And also the other measures which have been announced in the budget whereby there is an intent to attract foreign capital. I think the environment is set for a lower cost of capital, which actually supports valuations for the equity markets. The other factor which we have been worrying about is this whole NBFC related issues. And I think the key takeaway from the budget, or one of the positives we felt, was that clearly there was an acknowledgement of the problem. Some kind of a support was given. Now, how effective is that's going to be is something we have to wait and see. But clearly, there's a recognition of the problem, and a statement of intent is there that the government or the policy makers would like, or RBI would like to step in as and when the case may be. So that probably eliminates the risk of a major slowdown or a very deeper slowdown. So if you look at what our macro team or economics teams are forecasting is essentially a revival in growth. So we are below 6% today, but by the first half of calendar year 20, we are saying we will be closer to 7 or even higher than 7% growth. So essentially our growth trajectory is upward from where we are today, supported by a lower cost of capital. So that's largely the framework which gets us
fair
to...
point. In fact, fall in cost of capital is, just gives boosts to the valuations overall. But cost of capital has been edging lower for some time now. Maybe the acceleration in bond yield fall is last couple of days and weeks. But rate transmission was not happening. There have been 3 cuts. By when, or which quarter do you see the benefit of lower cost of capital start flowing in corporate India at a much more accelerated pace, and mainly financials, which your essential argument is that will be the beneficiary of lower fall in yields?
So since the ILFS crisis came to the fore in later last calendar year, I think we have been grappling with lower liquidity in the banking system. There were factors, there were concerns on current account at that point when oil prices were kind of moving higher. Foreign inflows were also quite low because there was an impending elections and there were concerns around there. So in general, the liquidity environment was quite tight. Now, for the first time, I think from sometime mid of June or early June, we have started to seeing a good amount of liquidity in the banking system. So I think, a higher amount of liquidity is something which would be required for transmission of rates to happen. So I think we are at that point, and I am hoping, and we have to wait and see how this plays out. Of course, there is reluctance to lend, right? I mean, because there is an element of cautiousness among lenders. So that's obviously is understandable. But as liquidity improves, it kind of helps at the margin to pass on the fall in rates. So we are expecting, rate transmissions to gradually improve from here on.
So your conversation with corporates, mainly the financials and NBFC heads, what is the kind of feedback you get in your own calculation? Because first quarter, the numbers are expected to be washed out across sectors. But sequentially, do you see numbers improve from here on?
So, essentially, the interesting thing is that you have corporates who would be the beneficiary of this fall in cost of capital, or NBFCs or financial intermediaries who are beneficiary of a fall in cost of capital because they are perceived to be somewhat better quality names, right? So they can have access to capital at a lower cost. At the same time, because there are lenders and intermediaries who are in stress, they are in a position to gain market share. So we are looking at pockets where companies are, or the lenders are able to borrow at a lower rate and also gain market share in the end market, right? And the pricing still is quite good there. So there is an argument for improvement in spreads for those financial intermediaries. So that's something which we are expecting will play out. If you look at financials, which obviously is one of the bigger contributors to our growth forecast, earnings growth forecast over the next couple of years, for this quarter, our analyst forecasts, I was just looking at it, for most of the NBFCs and corporate banks that we cover, and which matter, it's almost 19-20% kind of a growth that we are seeing in operating profits of PPOP for these companies. So I think it's not really that bad. It's showing signs of revival. And on the asset quality side, we are keeping a watch because there is incremental stress on NBFCs and HFCs. But we at this stage believe that it's kind of assumed in our numbers, but we are definitely keep an eye on that. So the biggest sector, financials, we are quite okay with the kind of earnings delivery that we expect to see this quarter.
The other big worry in the mind of the market is the kind of announcement on divestment which has happened from the government side, and people fear that one announcement on divestment and other the change of norm, higher share coming into the market and lowering of promoter share is actually crowd out the market in a way and will increase supply. But you have a contra view that it may not be immediate and spread over.
So we have to, yeah, I mean, you're right. So I think disinvestment target, we have seen numbers closer to 80,000 crores or thereabout. The fact is it has inched up higher compared to what was there in the interim budget. It's not a very big number. I mean, there could be other ways of monetizing also, which could include monetization of certain assets, like toll revenues, for instance, which can get monetized. So there are other ways of monetizing as well. So the number per se compared to where it was in the interim budget has gone up, but it's not really that dramatic, to have a completely different view on divestments. And the other question you mentioned about was change in ownership. Yeah, see, that's something which is a proposal at this point, right, which is the proposal to SEBI. And it's something which we don't know how and how long. So it's going to be a very gradual process. No immediate or major supply expectation that we have. However, these things, this increase in free float essentially could increase the weightage of Indian stocks in the benchmark indices, which in turn would lead to inflows. So that's something which, in a way, can negate the supply that we are, kind of talking about. And if you look at, some of the very marquee names would, figure there, I think there is very good demand, and there should be good demand for some of those papers. So
when you were talking to your universe of clients, all kinds of FIIs, what is the feedback you got regarding the kind of higher taxation or surcharge some of them will start getting now? Will be levied because of AOPs. What's the feedback there?
So the feedback, I mean, obviously we have seen in the market reaction and the voices which have been raised. So obviously incremental taxes is something which is negative. It eats into the returns clearly. Now, is there a way to kind of work around that? Frankly, I don't know. I mean, one has to wait and see how that plays out. But yes, at the margin, that's definitely incremental for the setup for many of the investors today.
Your call on autos, most of the auto stocks are at 52-week low anyways, apart from two-wheelers which are seeing relative buying, and you are structurally negative on it now. How prolonged could this slowdown be, and how risky could it be for investors to try and hunt for value there at this stage? Or do you think at later stage perhaps there could be a case for a relook there, but at least for now it's a strict no-no?
So, autos actually, we are probably slightly gone more negative than what we were earlier. So obviously, the stocks have been correcting because of slowdown. And one of the argument was that we kind of thought of, these are like well-run companies, generates a lot of cash flow. So, there's a high cash flow yield which should give support to these companies. But what we are seeing is that there is, continuous erosion or earnings cut, which is still happening, right? I think, given the nature of the sector, we could see further cut in earnings. So that worries us. So we have cut our numbers, but still there is a scope for further negative surprises as far as earnings are concerned. And then on top of it, we have to deal with the structural issue where, the government is trying to make a push for electric vehicle in a very serious way. I think, for the country, there are a lot of positives which can come out over the longer term. But and I'm sure a lot of, the auto companies are taking steps to participate in move towards electric vehicle. But that uncertainty remains. So whenever there is a disruption, how that kind of plays out is very difficult to kind of predict. So what I sense is that when you do not have an earnings support and the structural overhang, and some of the pockets, the ownerships have been high. So I think we may have to wait for somewhat more, where we expect the multiples to inch somewhat lower, and then probably relook at these names, and hopefully we'll get some clarity on the EV strategy, etc. But that's not in the immediate future.
Pharma is a space you have been positive on, but now you believe that there's a bigger turnaround at play, and selectively stocks have started looking positive there. Can you talk about any stocks?
So pharma, frankly, you've been positive. It hasn't really, worked out so far. Yeah, I mean, it's been very range bound, and we haven't seen a clear breakout in those names, and understandably, because we have seen big amount of disruption there, and earnings volatility has just been quite significant. But what we think is that we are closer to the bottom, and maybe we can debate as to how long will it take for the earnings revival and the stocks to perform. But I think at the margin, risk reward is favorable, and I think if you take a 2 years view, I think a lot of the issues will fall in place. So I think the biggest pain point has been the US generic space, and what we are seeing there is that it's still challenging, but it's not deteriorating any further as far as the pricing environment is concerned. And on top of that, there is an acknowledgement of the issues, and companies are taking steps to get their structure right, get their cost structure right. I think that's yet to kind of play out. And I think the expectations are quite low on any of the new initiatives that the companies have taken on specialty, innovation, etc., which can potentially play out, right? So if you add up all this, I think the risk reward is favorable, though it has been a laggard for quite some time, and it hasn't really worked in the last 1 year or so. But we are holding on to our call, and we think we won't lose much money from where the levels are. Yeah, it's debatable whether it's a 1 year or 2 year, but I think if we have a 2 year window, it's a good time to accumulate.
What's your view on utilities and some of the energy stocks for that matter? Because at least utilities are also a beneficiary of lower falling yields and lower cost of capital. Are you constructive there?
Yeah, so we don't cover utilities stocks at this point, but yeah, from a strategy perspective, we have overweight in our model portfolio as far as utilities is concerned. I think clearly, again, as you mentioned, right, a fall in rates is something which is positive for these names. In addition, I think as the growth revives over a period, I think, and of course the push for electric vehicle, etc., I think the electricity demand expectation from a longer term perspective is constructive. So yeah, so the combination of the two makes us overweight on this particular space.
And talk to us about your recent interactions with your client community or some of your last visits in the region. How are they looking at emerging market as a pack, and India within that pack? Because we are almost there for a rate cut cycle to begin in US as well. Yeah. We are in the middle, but they are also starting off. So how will India stand in that view?
So, in fact, I feel that there has been a material change in way people kind of look at India. I think before the elections, in early part of this calendar year, there was a lot of skepticism. Of course, there was issue with growth. The NBFC and IL&FS crisis came up at that point in time. On top of it, you had an uncertainty around the elections. I think from end of February, we have seen increasing interest in India among investors. And, on a relative basis, right, in the region, the uncertainties around trade war and India being less exposed to those uncertainties make it relatively more attractive compared to the other markets. So my interaction do suggest that there is higher interest today than what it was, let's say, at the start of the year.
And you also sound relatively less worried about the growth. There's a lot of gloom and doom on the street, at least regarding growth. You think in next couple of quarters, growth will trough out and we are almost at the bottom?
So we may not, so it will trough out, as you said, right? So we have gone below 6% on growth. And if you look at our forecast, which our economics team is expecting, we are talking about 6.5 or slightly more towards the second half of this calendar year and going up to 7+ in the next calendar year. So yeah, there is a gradual recovery trajectory which we are factoring in. So yes, so that's something which is quite critical, and we think that the potential deep slowdown is not our base case.
So when your clients, your interactions happen with them, where do you think their eagerness to buy lies and hence the inquiries are highest? Where are they curious to know more about but still not wanting to step their feet into? And which are the areas they are completely staying away from, even if you recommend something there?
Yeah, so I think clearly, the banks and financials is one space which gets the most, I would say, interest. Clearly, there is a story out there because there is a disruption and the market dynamics are changing. And as we had discussed last time, there's change in management which kind of augurs well for some of these banks. So I think there's a fair amount of interest in the financial space. Also, I think the government's focus on investment-led growth is something which makes investors interested to look at infra construction space. I would say these are the two spaces where we see quite a lot of interest. I think autos, again, because the stocks have corrected and there is a lot of, I do see eagerness, among investors to look at that space. So I think these are the areas, the key areas where I think we get a lot of interest. Obviously, I think, given, India has been a consumption-led story, so there is obviously an interest there. But, what we find is, one, the earnings expectations on consumption side is still high, and we just find the valuations too rich. And there is a very limited scope for error. So given the performance, we do see a lot of interest in these names as and when they correct. But what we think is that maybe it will be an underperformer from here on for quite some time.
Sure. One view I would like to get from you as a market participant, as a strategist on the broader market. Your universe is mostly large cap, but still an observation point of view, because market did become extremely concentrated last couple of months. Only a select basket of stocks are moving up. Historically, when this kind of phase happens, low growth phase, and broader market is shunned by a large section, when does interest come back, going forward? You must have seen previous phases as well, low growth phases. Or do you think market will be led by large caps, or recovery will be led by large caps only?
Yeah, no, I think, it's a very selective market. That's what we have been saying, that, one has to, it's look at, bottoms up, stock selection or portfolio making. I think there is a, good time to look at the smaller and mid-cap names, which, as you said, because of growth concerns, etc., they are kind of shunned out. If our hypothesis works out, right, where there's a revival in growth, you already have lower cost of capital, I think you could see a lot of confidence coming back to the mid caps and relatively smaller names. So from, I think again, this is a very good time, I think, to kind of look at that name. And of course there could be good names in the large cap space also, but as you mentioned that this is a segment which has been more or less ignored by the markets. And I find in certain stocks that I cover, the valuations are quite attractive, and I think the expectations are a lot lower.
Yeah, the universe itself is at a 5-year low in terms of valuation. So I'd like to end with this point of yours. Can we, out of all the conversation, the entire conversation I had with you, can we infer that in the next 3-4 years, the 6 months from here would be the lowest in terms of growth, and some of the weak parameters or high frequency indicators formed in the next 6 months perhaps could be the lowest we may see next 3-4 years?
Yes, I think so. I mean, that's the base case that we are seeing. So we are probably maybe a quarter or 2 quarters where we kind of grapple with the impact of the slowdown, which gets reflected in earnings, and that's when things starts to stabilize. And the market, I would say, is forward looking, right? So it tends to incorporate those things before the event happens actually. Yeah, exactly. So therefore I think similarly when the revival signs will start to pick up, you will see revival happening. So I would agree with your assessment that the next couple of quarters would be the time when we will probably in terms of worry would be the bottom point, and from there we would see a revival.
So if one were to go about making a nice portfolio of stocks or basket of stocks, probably the next 6 months could be a good time to do that.
Yeah.
All right, sir, and on that note, I'll let you go. Thank you so much for your time.
Thank
Always
you.
wonderful chatting with you.
Yeah, pleasure. Thank you.
Guys, that is back to you.